This is the current federal tax developments for the week of May the 20th, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. I'm Ed Zollers, broadcasting here again from Phoenix, still at home. Going to be going out places this week and hopefully bring you the updates on what's happening here in federal taxes. So what we had this week, we're going to start out talking a little bit of review about the Wolters Kluwer incident. What we got when we found out since last week's broadcast. Basically, the development for the formal relief that was given for those who were affected by the date might have trouble getting their May 15th deadlines out. We also have some news this week. The IRS released a new worksheet for computing taxes from Schedule D, where there's 25% or 28% gains because, oh, by the way, the worksheet they put out that has been used all year by your tax software almost certainly didn't compute the tax properly. So there's a little problem with all those returns already filed that have that computation, and we'll talk about what that problem is. The tax court gave the IRS a loss. Interestingly enough, it was an interesting case. Taxpayer was trying to argue the income was what should have been considered part of gross income. IRS was arguing it wasn't part of gross income based on their notice, and the IRS ended up losing the case. So interesting case where the court found something was includable in gross income, and the taxpayer turned out to be a winner. We'll talk about why the taxpayer won, and maybe their win was a lot bigger than it should have been due to how the IRS argued the case. The 10th Circuit Court of Appeals, though, gave the IRS a ruling in another case. We talked about this case back a couple of years ago when it first came out in 2017, but the 10th Circuit agreed with the tax court that an ESOP plan is a trust, which means that causes major issues for S corporations that have ESOPs that hold some of their shares. In essence, they really can't accrue the wages of any of the employees who are in the plan when we get to the year end due to Section 267. We'll talk about how that works. And finally, we'll talk about the fact the IRS yet again, and this is like the second time I remember ever seeing it, that the tax court found that the taxpayer was considering to be materially participating in an activity based on facts and circumstances. And I want to comment on this one mainly because I see a pattern developing here in what the tax court is doing, which is trying not to overturn their rulings about needing strict documentation. We're looking at the 500-hour test, but trying to find a way to still get a taxpayer in where maybe the strict documentation isn't there, but the tax court is pretty sure they really are very heavily involved. And we'll talk about how that worked out in this case. So we'll start this week. As I said, be on the road this week. I'm actually going to be lecturing this week. I'll be doing a 2-hour session on Tuesday in Somerset, New Jersey for the Somerset Middlesex chapter of the New Jersey Society of CPAs. So if you're going to be around there and you're near that area, that'll be the one Tuesday morning. If you're listening to this early enough, you can sign up for it. I am going to be coming back to New Jersey. There is a location change, so I thought I'd mention it this time. I will be lecturing, normally be lecturing at the Roseland office of the New Jersey Society, but as you may be aware if you're there, they're in the process of moving and they're going to relocate effective July 1st. Well, when I come in June, it's a little too late to be doing anything in the old facility. It's moving time. So we will be holding that course at the Wilshire Grand Hotel in West Orange. So if you are there, I mean, it's not terribly far from there. I've always stayed at the Wilshire Grand whenever I've been presenting in Roseland, but now we're going to actually have our session there. So if you're coming there, do it. That course I'll be talking about. First day, we're scheduled to talk about accounting and auditing update. And second half of that course is accounting, auditing, and tax consideration for the cannabis industry. Okay, kind of an odd duel, but I'm going to be doing that. So we'll talk about those issues, even though, as you're probably aware, in New Jersey, there's been a bit of a hiccup on getting, cannabis legalized for recreational use. Yeah, that's there, but we can still talk about it because they're planning on expanding medical. So we have that. And then day two, a little more traditional, what I'm going to be doing, Nexus After Wayfair, multi-state income and sales taxation for businesses, June 19th. That course will also talk about why, even though it's not technically a business case, we probably have to be very worried about the Kastner Trust case, because that may tell us a lot about how multi-state taxation is growing. So you can sign up for those New Jersey Society website. Take a look there. If you're going to be in Somerset on Tuesday, I'll see you then. Let's talk about our first thing I want to discuss this week, and this is just kind of rounding out the Wolters Kluwer developments that occurred. If anybody was kind of asleep last week or didn't hear about it, there was a malware incident in Wolters Kluwer systems that caused Wolters Kluwer to shut down their system suddenly on Monday, May the 6th. What ended up happening then is after May the 6th shutdown, we ended up having to, we ended up working with, you couldn't do certain things. If you were an Access customer, you really couldn't do anything on anything you licensed through Access. If you are a Pro System FX customer or an ATX customer, you could not electronically file, nor could you get any authorizations to file returns. Various other things happened. All of this eventually came back as that week went on, but by the time all functionality was restored, it was actually Monday of last week. Finally got really everything up and running, and all pieces were firing again. Because of that, the IRS did grant relief to May 22nd for late filing. If you are impacted by that, which means generally you're using Access, Pro System FX, or you're using ATX, Wolters Kluwer had a detailed summary of exactly what you need to do to automatically be granted that relief. Now, remember, it's only good through May 22nd. So if you're listening to this after Wednesday, don't worry about this. You already missed out on it. If you are still there and trying to do it, remember, May 22nd is there. And remember, it's not just going to give relief. You have to put codes in. You have to basically put a specific explanation, a specific place for reasonable cause. And there's a place the IRS has defined it to go. And you need to make sure you follow that Wolters Kluwer advice. If you didn't get that email, it is available on Wolters Kluwer's site. It's been posted a couple places. But if not, you probably want to go ahead and call Wolters Kluwer and get that together. Make sure you put it in the right place. We've got that. Now, the other interesting thing was that they also granted relief. Some states, but not all states, granted relief. And that was kind of hit or miss. So you may still have problems at the state level if you had a May 15th deadline. And even though the IRS granted you relief, you may still find some issues with the states. Wolters Kluwer had a list of states. Most states were on the list, but not all states were on the list. That's where it gets troublesome. For instance, California was missing from the list, but New York was there. It was kind of odd who was there. Arizona was there. We were here, but New Jersey wasn't there. So it's kind of odd, and it's not quite clear, why states went in, why states didn't, who got up and who got running. But you need to be, working on that. Now, at this point in time, as far as I can tell, everything is back up. I've not heard from anybody who had any of the affected Wolters Kluwer services that is telling me they still can't do things. I mean, it took longer to get certain things up, like their billings, to be able to pay for stuff, to get authorizations. It took a little while longer to get those things together, but it appears right now they're back up. They did announce this week that they were not going to do the software update that was scheduled to happen this weekend. So I should say last week they announced that. So that's been delayed for obvious reasons. They didn't develop the update. So we have a little bit of issues there. The thing to take away from all of this, though, and don't just sit there feeling smug if you don't use any Wolters Kluwer products. And also, by the way, if any of these are listening, if you are with one of the other enterprises, like if you're with Thomson Reuters or you're with Intuit, you shouldn't really look at this as mainly only a marketing opportunity. This is an interesting case study in issues that are going to relate to system security and as well responses to system security. A lot of people, of course, are very upset about the lack of communication following the incident. And to be totally honest, I think a good part of that was because a lot of what Wolters Kluwer had thought they would depend on to communicate with their customers, and usually use to communicate with their customers, ended up going down as part of this particular attack. And they took it offline for safety, but it meant the response wasn't there. I think a number one takeaway you probably should have from this, regardless of anything, any other way you look at it is, you got to be prepared and think through, if something happens, exactly how you respond. And also understand that no matter how wonderful your plan is for response, you may discover when the actual incident occurs that there's something you hadn't considered that's going to cause problems with your incident response. And that was part of, I think, what impacted Wolters Kluwer's here. So I don't think anybody suggests that, the news got to everybody easily during this issue. It did get there, and we got it together, and I think everybody ended up getting the stuff they needed eventually. But it's certainly for the first few days there were problems. We don't yet have much information about what exactly caused the problem. and how exactly the malware got in the system and what damage the malware did or didn't do. But just kind of be aware, that stuff will probably take a while to come out, probably will eventually come out, because Wolters Kluwer being a public company, they're under a little more scrutiny that is going to make it difficult for them due to various rulings with government agencies, especially those looking at their stock, worried about this, that they have to make some disclosures. So we'll probably get some idea of how this worked, some idea of how it got in the system. And, that there's always a takeaway. Every time an incident like this happens, there are a couple of takeaways for it. Number one, I think almost everybody looks at some of these and goes, "Oh, that really could happen here." And then you got to kind of think about doing your system. You hadn't thought about that way in, and now there's that way in. The other thing to take away from it, we usually find that there's something that just we hadn't thought was a problem that turned out to be the problem. Obviously, we want to take a look and try to learn from this situation. And as I say, learn on your own. I know a lot of us were upset because we weren't contacted, but then you got to ask yourself, what kind of contact system do you have? If something happened, let's say your email went down and your phone system went down, what would you do for a backup? Are all your, do you discover, which sometimes we do, that, we don't have access to our clients' phone numbers and everything if the computers go down, because we've got everything, electronically stored. And if our contacts list is down, if our address book is down, if your Exchange server goes down, none of that stuff's there. That could be a problem. So it's an interesting lesson, and I think that's what we have to learn from this. Let's start with what was probably the biggest issue of the week that kind of popped out late in the week very quietly. On the 16th of May, the IRS just on the website said, "Oh, by the way, we have a little problem." The IRS on the website this week posted a page titled Error in Tax Calculation of Schedule D Tax Worksheet Form 1040. The IRS announced that the worksheet for computing the tax when you're in the maximum capital gain rate range and you have 25 or 28% gains. Now remember, 28% gains generally are collectibles. 25% gains, which is the one we're probably going to see a lot more of, are that non-recapture, the 1215 non-recapture that we tax at 25 rather than at the maximum 20% rate. So the max 25 versus max 20. Those rates, those issues were causing problems in our worksheets. It turns out that basically it appears from the IRS's description that the problem was that worksheet, if you actually followed it, always forced you to use, in essence, those rates instead of the actual rates the taxpayer should have been exposed to, even if those rates the taxpayer were exposed to was lower. There are certain situations, and there's a combo thing going on there, where on a very limited number of cases, that could end up causing the tax to be undercomputed. In a much larger number of cases, it caused you to overpay your tax. Okay? That is the problem we've got. The IRS tells us that they had contacted the vendors, software vendors earlier about this and told them about this problem. So they claim that at least now the current version of software, supposedly they kind of quietly, oh yeah, they've all got it fixed. Now that's kind of interesting because I saw an email from Lacert that kind of told you, well, it's fixed as soon as we get this new update out. That's going to be kind of the question. And I think it's a question for a lot of us. Did they fix it? And if they did, in which update? Obviously, those of us as Wolters Kluwer are a little more interested because Wolters Kluwer's update system has been a little bit broken now. And I would say maybe it was fixed in the May 6th update. We're not sure if they had it by that date, and which would be kind of interesting if they did, because if they had it by that date, it meant all the vendors kept it under wraps. And kind of interesting, the IRS said, returns filed after May 16th will have it correct. It was, well, what they were told to intentionally miscalculate through May 16th. Or, how does that work? I was still not sure on the software, what the IRS is telling us, that somehow they're wrong through May 15th, but they're right the day after. I'm not sure the IRS is quite aware of the fact that the software vendors probably can't fix this in 2 seconds. and suddenly have it working. So again, you need to check with your vendor to see what it is. But the IRS does tell us they apparently are going to somehow, though they tell us to check in later, be able to fix the incorrectly computed returns. They do say straight up front, any return filed May 16th or later, they will correct the calculation if the calculation is in error. They claim that they'll check the other, they say that you go ahead and check your old returns by running through the worksheet, but don't file an amended return. Okay. So you can find them, but you can't, we don't send us an amended return. We'll fix these. One preparer had mentioned on a discussion forum that they had already received, they had a client that had received a notice that, as far as they could tell, appeared to be related to this. Now, that's a little interesting because it's kind of early. But if so, it was a standard, there was an error in calculating your tax. That could be a problem if the IRS issues them that way, because that strongly suggests, as all of you may think right off, your client's being told, hey, that CPA fouled up entirely in computing a return. They couldn't even compute the tax right. I wonder what else they got wrong. We'll see if the IRS develops a better way of phrasing that. I have a feeling for those that are being fixed by the computer when filed, though, that standard letter is going to go out. So you may want to try to figure out and compute. This will be a little more fun until the software gets updated, but at least try to identify your clients that may have this problem and warn them that they're probably going to get a notice from the IRS that will either refund or not refund. Again, I am hoping that, like, in case of Wolters Kluwer's, who we use, they all quite often do give scan software that can scan the returns and tell you which returns appear to have the problem. And that would be very, very useful to get that out, especially before the IRS starts sending notices, so that we could, basically preemptively contact clients and say, there's an issue on the return. The IRS, the IRS fouled up computing. Why did they foul up computing? Well, pretty much this appears to be strongly linked to the Tax Cuts and Jobs Act and the fact that the TCJA divorced the capital gains rates from the rates that applied, from the ordinary tax rates, because it used to be they were tied and they kicked in at those levels. And rather, the capital gains rates now kick in, max rates start kicking in at levels that are different rates, kicking in at levels that are determined by the old rates rather than the new ones. And not surprisingly, the worksheets appear to have not properly taken that into account. That creates our problem. So yeah, it's understandable. The second point here, well, we've all been told all along, you cannot trust IRS instructions, right? IRS instructions are not the law. If the law doesn't agree with IRS instructions, the law, is what matters. So in theory, I suppose, had you gone back and actually went from the law, went to the tables, and instead of following the IRS instructions, you had simply actually computed this, which, remember, is not exactly dirt simple. There's a reason why the IRS worksheet is as long as it is, because getting all these change in rates and times get interesting, but you would have probably discovered the issue. My guess is somebody did discover the issue. Somebody did send in a, return to the IRS or a, document saying, hey guys, really this number is wrong, because, had you submitted the number with the correct tax, the IRS computers through May 15th would have corrected the return, put the wrong tax in. So I suspect somebody actually probably did this by filing a claim for refund and saying, it's just done wrong. And you know what? Yeah, it is just done wrong. So anyway, be ready for that one. It affects all software as far as we can tell, everything that was done. So unless you notice this, yeah, you probably got a problem. Well, let's talk about IRS other little goof of the week. This is Indirect Group. This is Fay versus Commissioner 152 TC number 15, issued on May 15th. Now, this goes back to a 2014 notice the IRS gave. In notice 2014-7, the IRS ruled that if you are receiving what are called basically Medicaid, Medicaid payments, compensation payments for Medicaid for taking care of your adult disabled child. The IRS prior to that notice had held that those payments were taxable income. Now, those Medicaid waiver payments, as they're called, the problem is Code Section 131 has a rule that says those are not taxable, but it comes under foster care payments. And the IRS position had been, through before Notice 2014-7, that the basic rule of foster care is somebody put under your care, right? A child put under your care, and a natural parent can't be the foster parent of their own child. That it just doesn't work that way. That's not foster care. So he said because 131 was limited to payments related to foster care, these hardship style payments under 131, or difficulty payments, if they were paid for your care for your adult child, and yes, you can qualify for that, Medicaid, because you're saving Medicaid money because the adult child does not have to go into a long-term care facility, those payments would be considered non-taxable. They'd be taxable prior to 14 because they weren't foster care. In 14, the IRS, because people were whining about that, it seemed unfair. That was crazy. Really, Congress couldn't have meant that, could they, et cetera. So the IRS said, okay, we'll treat them as non-taxable. Now, that's all well and good, except we ran into an issue. And by the way, the taxpayer in this case, the taxpayer went ahead and said, yeah, that's fine. We will treat them as non-taxable, okay? So the taxpayer didn't pick them up, right? What the taxpayer did in this case was he followed that guidance, but he counted the earned income for calculating the earned income tax credit and refundable child tax credit. So again, he put it on, because this is what the notice told you to do. He put it on the 1040. He then, below subtracted it out. So it was not included in his AGI. But when he went to compute earned income credit, he treated that as earned income for the year. Now, the IRS said, well, wait, that can't be earned income, right? It doesn't count because, it wasn't taxable. And the tax court took a look. What the law tells us, earned income for EITC and refundable tax credit, earned income includes certain items paid. There are some other exceptions, but items paid in the way of compensation that are includable in taxable income. Now, the tax court then discusses includable is the different from included in taxable, included in gross income. And they said this clearly is includable because IRS, you were right with the way you looked at this law before 2014. You cannot be a foster parent for your own natural child. Since 131 only allows exclusion for foster parents, payments under foster care programs, and this is not a foster care program, this is earned income. And so, IRS, you're reaching beyond your rights of things to do when you take this out of earned income and are telling the taxpayer they cannot get earned income credit or refundable child tax credit for payments, by including this number in their calculation. IRS, you're just wrong. You don't have the right to do that. Congress would have to do that. The IRS said, but they didn't put in their income. It's like they're getting a double benefit. They're not meant to pay. Congress clearly didn't mean for a double benefit. Tax court said, that's probably right. Congress didn't mean there to be a double benefit, but it's not Congress giving a double benefit here. It is the IRS's own actions that are creating the double benefit. And the court pointed out, the IRS in court never argued that if in fact this was going to be counted for earned income tax credit purposes, that it should be included in AGI. They said, maybe we'd have bought that argument, but you never made the argument. So because you never made the argument, we're not going to let you make it now, and we're not going to insert ourselves to do it. So taxpayer gets away with no inclusion income for these payments, but he gets to get earned income tax credit, refundable child tax credit based on it. Now it becomes interesting trying to figure out what will the IRS do. And we'll just have to watch. It is a reported tax court decision. So if you go back to the tax court, we're going to keep getting this result. The IRS may be a little concerned. Depends on how many of these are out there, but I've got to assume there are a number because in a lot of cases, when the parents are having to stay home and take care of the child, that's certainly reducing their income, making it more likely they'd be in your income credit level. If there are a number of these, will the IRS now try to remove Notice 2014-7 And if they do, how do they handle it otherwise? I'm not sure what they'll do. I wouldn't be surprised to see them come in and say, okay, we understand this 2014-7 is not correct. However, we won't force you to amend your return to make that taxable, but we are going to say that if you file a claim for refund and try to claim earned income credit, then, or, refundable child tax credit or any other sort of credit that you'd qualify for by having the extra earned income, we're not going to let you do that unless you make the change to fix this error. Now, whether this is good news or bad news kind of depends on whether your taxpayer is going to get the credits or not, and whether the credits are worth more than the tax on the income would be. But it'll be interesting to see the IRS's response to this, or more appropriately, will the IRS try to get Congress to fix it? That's not as easily said than that's not as easy to do as it might think it is. We're watching some issues now that Congress is apparently supposed to fix, and while the children of those who died in the military, that little problem with the TCJA looks like we're going to find a way to get that one fixed. That's the sort of thing that they'll tend to fix. But other ones like this are a lot tougher to get through. Remember, we're still waiting on trying to fix the retail glitch. So could be interesting if you have clients who have this. We're getting these Medicaid waiver payments for caring for their adult disabled children. Keep a close eye on how the IRS responds to the Fay case. Taxpayer won, but that may not be good for your taxpayer. Next up, this time the IRS at least does win. No mistake of the IRS, and they won. Peterson versus Commissioner, 10th Circuit opinion. There are actually two cases here. They're cases number 179003, 179004. It's generally referred to as a Peterson case because that's the first name coming forward. It was issued on May the 15th of 2019. We had talked about this case back in 2017 when the tax court ruled on it. And the issue involves an S corporation that has an employee stock ownership plan. The question we're looking at here with an employee stock ownership plan, if your S corporation is on the accrual basis for tax, are the participants in the plan, because the plan holds shares of stock, are those participants considered beneficiaries of a trust that under Section 267 are deemed to be shareholders of the S Corp, and also by that 267 will apply that therefore, because you cannot accrue payments to a cash basis taxpayer and have them deducted before the cash basis taxpayer has to include those payments in income, are they actually barred from accruing wages for those people? The tax court had said yes. The tax court said that thing is a trust. The tax court said, look, it's a trust. The law says it has to be a trust. It's clearly a trust. Yeah, we know ERISA has some special rules, but it's still a trust. We don't see any place where Congress said that this trust didn't count. So because of that, we are disallowing entirely. The IRS was correct to disallow entirely the accrued wages at the end of the year, which would also include any accruals in a bonus program at the end of the year for the employees, that they can't deduct that until it's paid. The taxpayer appealed this case to the 10th Circuit. They said, well, they said basically, look, the IRS ruled that this is a trust for 267. That doesn't make sense. Congress couldn't have meant for that to be the case. Well, unfortunately for the taxpayer, the 10th Circuit agreed with the IRS, or with the tax court and the IRS. 10th Circuit said, look, this thing's a trust. ERISA requires these shares to be held in a trust. That's what ERISA says literally. It's a trust. Yes, this trust is subject in most cases, in almost all situations, to ERISA preemption. That means state courts don't get to play with this trust. But nevertheless, we use the same principles to deal with this as a trust when we do get in federal courts on it. It is a trust. Nothing in the law says it shouldn't be a trust. It said it shouldn't be treated as a trust for this purpose. The 10th Circuit was rather dismissive of the taxpayers' methods of trying to argue otherwise, essentially almost ridiculing them, saying that they couldn't follow all of them, and they were kind of absurd. The ways they tried to argue it wasn't a trust. Now, this is interesting because I've been approached when we talked about this back in 2017 by practitioners in multiple cases that were like, wait, we've never worried about accruing wages for the S Corp and ESOP. You need to worry. Again, it's a published tax court decision. So if you go to tax court, you're going to get this result. And the 10th Circuit Court of Appeals, which was the court of appeals to which this appeal would be heard, has said it's a trust. Yes, you might have a chance outside the 10th Circuit. Remember, the 10th Circuit is primarily, the very southeast. So the 10th Circuit picks this up. It was or I'm going to say not 10th Circuit. That's not southeast. Primarily like in the middle. It's in New Mexico, Colorado, etc. Yeah, I got it right. I think it was the 11th Circuit there. 10th Circuit is in New Mexico, Colorado, etc. is where the 10th is. So the 10th Circuit, if you're there, you're definitely got a problem. But even if you're not there, you likely have a problem because, again, we don't know, would the 9th Circuit or the 2nd Circuit or the 4th Circuit, the 5th Circuit, would they hold differently? We don't know, but we do know one thing right now. I here in Arizona, if I have a client that's an S corporation, that accrues wages for its participants in the S corporation, I know the IRS challenges me on that. I'm going to have to go all the way to San Francisco and get before the 9th Circuit Court of Appeals if I'm going to get that result the way I'd like to see it, because the IRS has solid on their side. They know if they go to tax court. I mean, assuming the agent just isn't, not terribly up on what's happening. Reality is the IRS should be solid all the way through. You've got to get all the way to the Court of Appeals. And that's a really expensive on legal fees, even if you win. So yeah, this is a problem case. Next up, this is the case of Barbara versus Commissioner, Tax Court Memorial Case 2019-50. It was issued on May 13th of 2019. And this is a case dealing with passive activities. This taxpayer had sold his trucking company, used the money from it to start a lending business. He was loaning money. Now, he actually hired 2 employees in Chicago, an accountant, one other employee. Were always in an office in Chicago that he had for this business. But he spent 60% of the year in Florida. Okay. He only spent 40% of the year in the office in Chicago. And so the IRS looking at this with the 2 employees. Now, again, this is not Section 199 where we can count the work of those 2 employees to say this is a trader business. It is a trader business. But here's our problem. They're saying that, look, because he spent most of his year in Florida, the office was in Chicago, the IRS says, hey, this is a passive activity. Now, the tax court took a look at some details. I think the IRS got totally hung up on being in Florida most of the year and just kind of put blinders on, didn't do it. The tax courts looked at the information and looked at, testimony of what was going on. Now, what's interesting too, and I think this also was probably running the IRS, nowhere does the tax court tell us that the taxpayer had records of hours spent. In fact, it's very obvious when the taxpayer analyzes what the shareholder did. The tax court is using a very rough calculation on average hours per week when they're in Chicago, average hours per week when they were in, Florida for the weeks in question. Now, you may remember that kind of rough calculation is one that the tax court has rejected multiple times when people have tried to say, yeah, I had more than 500 hours. I was materially participating, or I had more than 50 hours to be a real estate professional. They've constantly rejected that. But in this case, the tax court found in favor of the taxpayer. But they did it interesting. This is very similar to a case we had before. And this was a case that we ran into many years ago, which unfortunately there it is, Wade versus Commissioner, 2014-169, where again it appeared to be a taxpayer that clearly seemed to have done a lot of work to get something happening. In Wade, he basically saved the company. After having retired a number of years ago, he came back and saved the company effectively through his work. In both cases, in Wade, the taxpayer had claimed more than 500 hours. In this case, the tax court's math adds up to more than 500 hours. But in neither case, the court never said they didn't have 500 hours, but the court didn't use that exception. So it appears what we're seeing here indirectly is the tax court, if you have a situation where based on evidence that is not contemporaneous evidence of exact level of activity, but is evidence of what we suspect the activity should be. So it's a Cohen kind of level of proof. And we can show what the taxpayer did was important to the business. That what the court's doing is to avoid having to say that, oh, well, we're just going to go ahead and allow his guesses that he's over 500 hours because we kind of think that's right. What the tax court instead is doing is says, well, he clearly had more than 100 hours. That there's enough evidence to say without any question he's more than 100 hours per, even more than 100 hours in a year. And because of that, they're using the seventh test, the facts and circumstances test, and make them materially participating in that fashion. This, again, I would never, ever, ever suggest relying on this to a client because this is, you got to look good to the court, things have to be right. But it could give you a bit of leverage in an exam to cite Wade, to cite Barbara, and indicate, look, this guy meets these requirements. Yeah, you may say there's some flaw and that he didn't have enough real detail to prove through logs and everything this exactly what he did to get to 500 hours. But there's enough evidence he clearly got to 100. And we think, based on Wade and Barbara, that the court's going to find for us because he materially participated. Will you win that argument? May or may not. And as I say, I would never want to actually, when telling a client, when telling a client right now saying for 2019, I want you to go ahead and get the records. Absolutely. I want to have the solid records. I want to have the 500 hours. I want to have it tied down. But we all know that, you get that. The client swears it's all there. And when you go start getting the records from them, when the exam letter comes, suddenly it's like, oh, well, yeah, I know. I said I had it. I know it right there. It says I had it. But, well, I didn't think you meant it. Oh, good. So you might have a chance to get through with it. So keep an eye on this because it's interesting that apparently the tax court is, at least it would appear to me, kind of quietly and informally carving out a second method through, but you got to have really good facts and circumstances. But if you do, the fact that your records aren't really great probably won't kill it. It is time now to register for your courses. Make sure you register now for those live CPE courses we're going to be teaching this year. We got a bunch of them on the schedule. We're doing them all over the country, doing them both in tax and A&A. And I actually just finished an A&A course in Portland, actually should say in Beaverton at the Society offices last week. Did that. I thought it was a wonderful deal that the Auditing Standards Board decided to issue a brand new auditor's report 1 week before I had to give an update on auditing standards. So that was kind of interesting. We spent time playing with that during the session. But we've got these all throughout the country. Make sure you take a look at it. You can find those courses. They'll be listed as Kaplan. I will warn you, the state societies, because of the name, as we've had the changeover, as Lascalzo and Nichols Patrick have been merged and become part of Kaplan, and we're now operating as Kaplan Financial Education. You may find us listed as Lascalzo. We may still be listed as Nichols Patrick in some locations for the tax courses. But if you see Nichols Patrick, Lascalzo, or Kaplan, that's us. And go ahead and sign up, and hopefully we'll see you at some of our classes coming up. This has been the Current Federal Tax Developments for the week of May the 20th, 2019. Current Federal Tax Developments are basically, every week we try to keep you updated. We do post regular updates on our website, www.currentfederaltaxdevelopments.com. I post stories there. The stories related to this week's developments are there. If you have any questions or comments, you can email me, edzollers@currentfederaltaxdevelopments.com. That's the best email address to contact me with questions, especially those that relate to the courses or these broadcasts. You can follow me on Twitter. My address there is @edzollers, and there are a lot of things. By the way, Twitter, I know Twitter has issues and Twitter has all kinds of quirks, but you actually can get on Twitter, limit yourself to following people who are actually posting tax news issues, and we can find us. And Twitter is an amazingly useful tool. I will tell you flat out, that was by far the most useful tool for the first 48 hours was Twitter and Reddit for dealing with the Wolters Kluwer incident. So basically, make sure, keep an eye there. I also follow discussions on 3 state societies websites. I use our Connect sites for sites I'm members of. That will include the Arizona, the New Jersey, and the Minnesota Society of CPAs. And I try to post updates there, respond to questions. And there are lots of other people that respond there too. So very useful place to interchange, especially if you're a solo practitioner. I also follow the Tax Talk site from the California Society. That's available to any CPA anywhere in the country. You do not have to be a member of Cal CPA to get into it. You do have to go to Yahoo's group site and request access to it. It's open to CPAs and attorneys licensed in any state or territory. So you should be able to get in and follow along there. And I also follow the subreddit /r/taxpros on Reddit. You can find out responses there, incidents there, what's happening. We can get some back and forth. That's also a good, and that one's also open to anybody. Otherwise, we'll kind of watch it this week. I have my early week trip into, first on Monday, I'll be in the New York City area talking with some people, so there's no presentation that day. And then day 2, I will be in Somerset, New Jersey. And as I say, Somerset, presenting with the chapter meeting that morning. They're going to, the first 2 hours of the meeting, I am not presenting on. That is research and development. It's still the R&D credit's a useful thing to get some information on. Second half of the day, I'll be presenting on restricted stock, deferred compensation, and all kinds of other neat things. So again, if you're in the area, sign up for that session, and we'll see you there in Somerset. And otherwise, I'll see you all back here next week as we'll start talking about what's happening in the coming week in the area of federal tax developments.